What is happening, people? It is your boy Jack. Very welcome to today's video. Today we're going to be speaking about 5 Dividend King stocks. A Dividend King is a company who has paid and grown their dividend for over 50 years. For over 50 years, 5 decades, these companies have made enough money to reward their investors by paying them dividends and actually increasing that dividend every single year. Even during the Great Depression, these companies were making enough money to keep on paying their investors and even pay them more than the years before. And not only do they pay this dividend, but they've also grown in price as a whole. So it's a win-win from an investor's point of view. The longer a company has paid a dividend, the more likely it is to do so in the future. Look at a company like Delta, for example. They paid a very nice dividend for 9 years, but as soon as times got tough economically, they had to completely cut that dividend and their investors are no longer getting paid every 3 months. Right before we get into the very first Dividend King of today, please smash the video a like, it helps me out massively. Subscribe if you are indeed new around here, and drop me a comment with your thoughts on any of the companies we speak about today. But anyway, let's get straight into the very first company. And just to make it known, I actually do own a position in every company we're going to speak today, so I'm going to bang that up on the screen now, just so that you can see I'm not speaking about them for no reason. I do believe in them enough to actually put my own money into them. But first of all, here is Coca-Cola. We all know exactly who Coca-Cola is. To understand just how big Coca-Cola is, here is a list of their brands from Wikipedia. Boom, boom, boom. They have an awful lot of products. Let's just put it that way. But some of the bigger brands that we all will obviously know: Coca-Cola, Sprite, Fanta, Dasani, CL, Smart Water, Minute Maid, Simply Orange. The list goes on and on and on. Especially if you're in the US, you will know pretty much every single one of these brands. They currently have a dividend safety of 80, which is safe, which is always great to see. A nice dividend yield of 3.41%, and of course an uninterrupted dividend streak of 57 plus years. And this is obviously what we're going to be speaking about the most today, but for the last 57 plus years, Coca-Cola has paid its investors. I'm 22 years old, so for the equivalent of 2.5 of my lifetimes, Coca-Cola has been rewarding its investors with dividends. I see absolutely no reason for this to stop with Coca-Cola. They understand how attractive this is to investors. They're going to keep paying it even when times get tough. They're going to do everything in their power to keep paying that dividend, and it is 3.41%. That's a lovely dividend. In general, I like to get dividends of 3.5% plus. But with a company as big as Coca-Cola, who's paid them for so long, to get anywhere near that is amazing. In general, the bigger a company is, the bigger the growth potential a company has, the less dividend they have to pay. You know what I mean? People have other reasons to invest in these companies. Coca-Cola could get away with a much smaller dividend and still have pretty much the same market share, but here we are with that lovely dividend. And just having a look at their stock chart for the last 5 years, we can see we're at $40.89. There was some nice, steady, consistent growth, got up as high as $60. It fell back down as low as what, $38, and now we're sitting at $48 on the button. In only 5 years, it went from pretty much $40 to pretty much $60. It went up pretty much 10% average year, which is awesome. And we can see that since the Great Depression, it has been a steady climb upwards and only upwards ever since the Great Depression. So that is also awesome to see. And here's how it performed during the last recession. It went down 31%. The S&P 500 went down 55%. So significantly outperformed the market, which is important to know, especially when we are looking for some of the safest long-term companies. In a time like now, we're in such a struggle economically, it's good to know that they outperform the market in general. But anyway guys, that is Coca-Cola. They don't need much of an introduction. That's stock number 1. Now on to number 2. Johnson & Johnson, J&J. Every single one of you know who these guys are. A dividend safety of 99, a dividend yield of 2.66%, and an uninterrupted dividend streak of 57 plus years. Very similar to Coca-Cola, slightly smaller dividend, but a 99 dividend safety. And in such uncertain times, it's nice to see J&J hikes dividend 6%. Awesome, absolutely awesome. They're still doing exactly what we expect them to do, growing that dividend, paying us investors more and more money. And they can most definitely keep on affording to do this. The last 12 months, their earnings payout ratio was at 42%, and it's projected to be 52%. That is absolutely amazing given the circumstances, that they're still below their preference for most companies. And again, they absolutely smashed the general market during the Great Depression with a negative 27% return compared to the market's 55% return. Every single one of you watching who is an investor probably owns some Johnson & Johnson. Now, buying them as of right now, their forward PE ratio is 19.4, which is well above its 5-year average of 16.2, meaning that it may be a little bit more expensive compared to what it has been in the past. Obviously, stocks are more attractive when they're undervalued, as long as their fundamentals haven't changed, so this is definitely something to keep in mind when it comes to open up a position, but I think in the long term, you cannot go too wrong with this company. And again, looking at their 5-year chart. 5 years ago we were at about $100 a share. We got up to about $150 a share, and now look where we are. We're actually at $152 a share. They are performing absolutely incredibly, and their max chart is just something to behold. Look at this growth. Look at this absolutely incredible growth. There is a reason everybody loves to buy J&J. It's because people need their products. They're staples. No matter how little money people have or how much more money they lose, they're going to need their products. Here's some of their really popular products: Nicorette gum, Sudafed, Calpol, Listerine, Benylin, Benadryl, Aveeno, Johnson's, like products that you have in your house. But again, just look at that stock chart. It does not get much nicer than that. It's incredible. As I said, there's a reason so many people buy these guys, and I for one will definitely keep on buying these guys pretty much forever. And you can't speak about Johnson & Johnson without speaking about Procter & Gamble. It's just that simple. It has to be done. So Procter & Gamble, again a 99 dividend safety, a 2.54% dividend yield, and a growth streak of 62 plus years. It's just beautiful. Very similarly to Johnson & Johnson, they sell things that people need, okay? Tide Pods, you remember all the memes about Tide Pods? Lady products, Bounty, male products, Charmin toilet paper, Fairy, Oral-B toothbrushes, Pampers, baby diapers, things everybody needs, you know what I mean? Just because you make less money doesn't mean you're going to let your little baby shit his pants, you know what I mean? You're going to go and buy him some diapers. During the Great Depression, they returned minus 36%, so again, significantly outperforming the market. And again, their PE ratio was at 24.6, which is above its 5-year average of 21.5, so these may be slightly overvalued. Always something to keep in mind when it does come to buying these stocks. We don't ideally want to buy them when they're overvalued. But again, in the long term, just like with J&J, it's not too bad. And again, the 5-year chart, we were down at about $81. We went up as high as about 126, and now we're actually pretty much back there at 125. So again, performed absolutely incredibly. And again, just have a look at that max stock chart. Not much needs to be said. It's beautiful. Obviously, there's some down points in there, but in the end, it always shoots up absolutely massively. I just realized I forgot to show you my position in these guys, so boom, it is on the screen now. That's where I currently stand with PG. But if I had to choose two stocks that I will more than likely buy forever, despite what happens, it will be PG and J&J. They're not the most exciting in the world. They don't have the absolute most growth potential in the world. They don't have the biggest dividend in the world, but they are two extremely safe stocks. Those are just my thoughts and opinions though. I'm not a financial advisor. I'm a 22-year-old on the internet with a giraffe behind them. Now next up we have 3M, a company a little bit different to the previous three. Here is my current position in 3M, just so that you can all see that. They have a dividend safety of 75, a dividend yield of just over 4%, which is absolutely beautiful, and a growth streak of 61 plus years, which again is just absolutely amazing. Really quickly, we'll cover the basics of what 3M do. I don't want to go into depth. That's not what this video is about. But essentially, they're a highly diversified company with 5 main business segments that cover over 45 technology platforms: healthcare, safety and graphics, industrial, electronics and energy, and consumer. So they're highly diversified as a company. Now, during the Great Recession, they returned negative 54%, which is pretty much the same as the S&P 500. But they were able to continue raising its dividend, which could suggest that it's more recession proof than certain other companies. Now this is where things get a little bit funny for 3M. So if we have a look at their max stock chart, we can see there was some absolutely amazing periods of growth. Absolutely amazing. They obviously dipped during the recession, but they recovered incredibly, getting up to close to $240 a share, and now we're all the way down to $146 a share. And this began happening before the tough times that we've fallen on. But that honestly does not worry me too much. If anything, it gets me a little bit excited because I could be getting in at cheaper prices than it would be if the business was just to have kept on booming. Inevitably, some absolutely massive companies are going to go through bad years, even when the rest of the market is doing well. And one nice thing about 3M right now is that their forward PE ratio of 17.6 is below its 5-year average of 19.6, which means that it's actually somewhat undervalued and relatively cheap compared to how it has been in recent years. But keep in mind, this is only true if their long-term outlooks and fundamentals haven't changed, and I don't think that they have. Again, I've spoken about these in previous videos. We won't get into it. Maybe I will again in the future, but for now we won't. But again, that's 61-year dividend streak, a dividend safety of 75, and a dividend yield of 4%. Beautiful. Now the last company for today is Sysco Corp. Here is where I currently stand with Sysco. They have a dividend safety of 55, a dividend yield of 3.58%, and a dividend growth streak of 51 plus years. So only very recently have they gotten this Dividend King title. It's happened at an unfortunate time. They're going to be going through some really tough economic times now, but they're going to do everything in their power to keep paying this dividend. And what they do, they provide a full line of food products and non-food items to more than 650,000 customer locations, including restaurants, schools and governments, hotels, things along those lines. Now, why they may be hitting the short term, look, 62% of their sales are to restaurants. That's why they will be hitting the short term. But as soon as the economy's back open, restaurants are back open, people are buying food, they're going to be going straight back to Sysco to put their orders in. I can understand why this company's dividend safety is a little bit lower, but honestly, I think 55 is a ridiculous number. I think that they should at least be 75, 80. People need food. People love going out to restaurants. As soon as these restaurants are opening back up again, that's one of the first places people are going to be going once this all blows over. One of the things I miss the most out of anything right now because of these lockdowns is just going out to a restaurant and eating. So in the short term, I definitely expect more volatility than some of the other stocks we've spoken about today, but in the long term, I think it's fantastic. And what I really like is their forward PE ratio is 15.6, well below its 5-year average of 20.2. The stock is undervalued, and I still believe in the company, their fundamentals and their future. So to me, it's absolutely fantastic. Some people may not believe in them as much, but I do, and that's what's important when it comes to deciding what companies you are going to invest in. But all in all, I do think that they are very undervalued, which means we can get in at a good price. And I'm happy with the price point I've gotten in, and I definitely plan on buying more of this company. I am a long-term dividend investor. That's what I want 90% at least of my portfolio to be, is long-term dividend paying stocks. So to me, I need to invest in stocks that I believe will keep paying me even when times get really tough, as they are now, because a lot of companies are going to ultimately cut their dividend and already have started doing so. But anyway guys, if you did enjoy, please drop me a like and drop me a comment with your thoughts down below, or any other companies that you really like right now. I'm always interested in hearing from you guys. And until the next one guys, I'm going to say peace.